the smartphones that individuals utilize on a daily basis, the liquid crystal displays integrated into modern living room televisions, and the affordable electric vehicles traversing urban thoroughfares all share a common point of origin within, and the manufacturing facilities of one specific nation. However, the internal economic structure of this global powerhouse is currently exhibiting simultaneous and multifaceted fractures that suggest a profound systemic instability is beginning to take root. More than 60 million vacant housing units now stand as silent sentinels across the national landscape, creating vast ghost towns that reflect a misallocation of capital on a truly staggering scale. Furthermore, nearly half of the younger generation has reportedly abandoned the traditional pursuit of employment, facing a labor market that no longer offers the opportunities once promised by decades of rapid industrialization. The fiscal reserves of various local governments have reached a state of exhaustion, resulting in an increasing number of municipalities that are unable to fulfill basic obligations, such as the payment of salaries for civil servants. It is critical to note that these figures are not merely external speculations, but are derived from official announcements and public records released by the state authorities. Financial institutions such as Bloomberg and Goldman Sachs have issued warnings suggesting that the actual economic reality may be 2 to 3 times more severe than what is reflected in the official statistical data. This nation is China, a country that has served as the engine of global growth for decades, but is now grappling with a series of interconnected crises that threaten to destabilize its internal and external foundations. Today, we will examine the data and the underlying facts to unravel the complex web of challenges currently facing this massive economic system. An economy is essentially a living organism that requires the continuous and fluid circulation of capital to maintain its vitality and functionality. In the present context, however, the flow of money within the Chinese economy has been effectively frozen for several years, creating a state of stagnation that has profound implications for the future. This phenomenon is known in economic terminology as deflation, a condition characterized by a persistent and widespread decline in the prices of goods and services. While a decrease in prices might initially seem beneficial to the average consumer, it often functions as a deceptive trap that can lead to a prolonged period of economic contraction. According to reports from Nomura Securities, the Producer Price Index in China has recorded negative growth for more than 30 consecutive months since September of 2022. Consumer prices have also remained stagnant at near zero levels, indicating that the inflationary pressures typically associated with a growing economy have completely vanished. If inflation can be compared to a common cold that causes temporary discomfort, deflation is more akin to a cessation of blood circulation throughout the entire body of the economy. When prices continue to fall, consumers naturally delay their purchases in the expectation that goods will become even cheaper in the future, which leads to a significant reduction in immediate demand. Businesses respond to this lack of sales by further lowering their prices, which erodes their profit margins and forces them to reduce their workforce or shut down operations entirely. This creates a vicious cycle known as a deflationary spiral, where declining demand leads to lower production, which in turn leads to higher unemployment and even lower consumer spending. Another anomalous aspect of the current situation is the structural reality where companies continue to operate production lines even when every unit sold results in a financial loss. In China, this phenomenon is often referred to as internal friction or cutthroat competition, a process of self-consumption driven by an irrational struggle for market share. This trend is particularly evident in core manufacturing sectors such as solar panel production, electric vehicle manufacturing, and lithium-ion battery technology. These industries are currently generating a volume of products that far exceeds the total global demand, yet the assembly lines show no signs of slowing down or adjusting to market realities. This persistent overproduction is largely driven by local governments that fear the social consequences of mass unemployment and therefore continue to inject capital into insolvent enterprises. Financial institutions also play a role in this process by extending unrecoverable loans to failing companies, often under pressure from political authorities who prioritize stability over economic efficiency. The result is a situation where the entire industrial sector appears to be racing toward a metaphorical cliff, yet no individual actor is willing or able to apply the brakes. This is a classic example of the fallacy of composition, where actions that may seem rational for an individual entity lead to a disastrous outcome for the system as a whole. To understand the roots of this overproduction, one must look toward the massive black hole that has become the Chinese real estate market. The nation consumed more cement in a few short years than developed countries used over the course of an entire century, all in an effort to artificially inflate growth rates through infrastructure and housing. Expert estimates now suggest that there are at least 60 million and possibly as many as 120 million vacant apartments scattered throughout the country. Even the most prestigious office markets of Shanghai, analysis indicates that it could take 100 years to absorb the existing inventory at the current rate of occupancy. S&P Global has projected that the real estate market is unlikely to reach its lowest point until the year 2027 at the earliest. The sales value of new residential properties, which exceeded 18 trillion yuan in 2021, is expected to plummet to approximately 8.4 trillion yuan by 2025. Even former high-ranking officials from the Ministry of Finance have publicly admitted that stabilizing the housing market will require a minimum of 5 years of concerted effort. The reason this real estate collapse is so catastrophic is that a vast majority of household wealth in China is concentrated in property assets. As hundreds of millions of people witness their primary financial assets losing value before their eyes, they instinctively curtail their spending to protect what remains. This reverse wealth effect further entrenches the deflationary cycle, pushing the economy deeper into a quagmire from which it is increasingly difficult to escape. The collapse of the property market has also dealt a direct and devastating blow to the fiscal health of local government administrations. Historically, approximately 40% of local government revenue was derived from the sale of land use rights to developers, and when developers stop buying land because they can no longer sell apartments, the primary source of funding for local governments effectively disappears. Official data from the Ministry of Finance indicates that the statutory debt of local governments stands at 47.5 trillion yuan, which is equivalent to approximately 1,000 trillion Japanese yen. However, when hidden debts are included in the calculation, the total figure rises to more than 92.6 trillion yuan, a fact acknowledged by the government itself. Goldman Sachs has estimated that if off-balance sheet liabilities are taken into account, the total debt could reach $23 trillion, or approximately 3,400 trillion yen. These organizations functioned as paper companies that allowed local governments to raise funds for infrastructure projects that often lacked economic viability or a path to profitability. Consequently, there have been numerous reports of significant salary reductions for civil servants and the suspension of essential public services such as public transportation. The establishment of a dedicated debt management bureau by the Ministry of Finance serves as a clear indication of the gravity of the situation currently unfolding. The instability within the financial system has also begun to pose a direct threat to the personal savings and financial security of ordinary citizens. Individuals who lost faith in traditional banks sought higher returns through shadow banking products and trust companies, many of which are now failing to meet their obligations. Major trust firms have recently become unable to redeem investments, leading to the sudden disappearance of middle-class wealth that had been accumulated over decades. Even gold, traditionally viewed as the ultimate safe haven asset, has become a medium for sophisticated financial fraud and deceptive schemes. The collapse of various Ponzi-style investment structures, which used funds from new investors to pay returns to existing ones without holding any physical assets, has further eroded public trust. When the general population loses confidence in the integrity of the economic system, the foundational social contract between the state and the people begins to fray. As the situation becomes increasingly difficult to manage through traditional economic levers, the state has begun to implement measures focused on total digital control. This includes the widespread introduction of the digital yuan, a central bank digital currency intended to replace physical cash in all transactions. While this is often framed as a move toward the convenience of a cashless society, it also enables the comprehensive tracking of all individual financial activity. The implementation of a digital currency allows the authorities to monitor exactly where and how every unit of currency is spent by every citizen at any given time. Furthermore, there are concerns that the government could introduce expiration dates or specific usage restrictions on digital funds to force spending or control behavior. In the event of a financial crisis or a bank run, the state would have the technological capability to freeze individual assets with a single command. This transition suggests a future where an individual's money is no longer private property, but rather a government-managed token that can be revoked at any moment. The closure of the final exit strategy for citizens, which is the withdrawal of physical cash, represents a significant shift in the relationship between the individual and the state. The demographic most deeply affected by this multifaceted crisis is the younger generation, which faces a future of diminishing returns and limited social mobility. As of August, in the year 2025, the unemployment rate for individuals between the ages of 16 and 24 has risen to 18.9%. Research conducted by Peking University suggests that when accounting for those who have given up looking for work or remain dependent on their parents, the real youth unemployment rate may be as high as 46.5%. The sudden and aggressive crackdown on the private tutoring industry and the tightening of regulations on major technology firms resulted in the evaporation of millions of high-quality jobs. Elite graduates from prestigious universities now find themselves working in food delivery or basic assembly line roles, a reality that has led to a widespread sense of disillusionment. This has given rise to the lying flat movement, where young people choose to opt out of the competitive labor market and reject traditional milestones such as marriage and homeownership. This phenomenon is more than just a social trend, it is a form of silent protest against a system that many feel no longer rewards hard work or ambition. The government has expressed deep concern over this development, as a passive and unmotivated youth population threatens the long-term stability of the national project. In an attempt to address the potential exhaustion of pension funds, the authorities have recently announced an extension of the mandatory retirement age. However, this policy change has inadvertently intensified the competition for limited job opportunities between the older and younger generations. Older workers are unable to retire, which prevents younger individuals from entering the workforce and moving up the professional ladder. This generational struggle for a shrinking economic pie is taking place against the backdrop of a demographic structure that is increasingly resembling an inverted pyramid. The long-term consequences of the one-child policy are now becoming fully manifest, with internal projections suggesting that pension funds could be depleted within 10 years. The birth rate continues to decline to historic lows, while the working-age population is shrinking at a rate that poses a structural threat to the nation's manufacturing capacity. While these internal fractures expand, the country is also facing a strategic encirclement by international powers seeking to sever its access to critical technology and capital. This is not a simple trade dispute, but a fundamental shift in the global order that aims to isolate the nation from the most advanced technological supply chains. The export of high-end semiconductors, as well as the software machinery required to design and manufacture them, has been strictly blocked by a coalition of developed economies. The technological gap between domestic firms and their counterparts in the United States and Japan is widening rather than closing, despite massive state investment in indigenous development. European nations are also increasing their trade protection measures, leaving the excess production of Chinese factories with fewer and fewer markets to enter. Although the country recorded a record trade surplus of $1 trillion last year, this figure is not a sign of economic strength, but rather a symptom of weak domestic demand. This strategy is meeting increasing resistance from trading partners who are concerned about the impact of subsidized goods on their own domestic industries. The projected growth rate for the economy is trending downward from 5% in 2024 to 4.8% in 2025. Moody's has forecasted that the average growth rate between 2026 and 2030 could drop as low as 3.8%. While the government has promised more aggressive fiscal policies and monetary easing as part of its 15th five-year plan, the fundamental issues remain unaddressed. Without a recovery in the real estate sector and a restoration of consumer confidence, traditional investment-led growth is unlikely to produce the same results it did in the past. This situation is not merely a localized concern, as the global supply chain is too deeply integrated for any major disruption to be contained within national borders. If the world's primary manufacturing hub experiences significant instability, the ripple effects will be felt in everything from commodity prices to global logistics costs. In the short term, fluctuations in energy and resource prices could have a direct impact on the cost of living in nations like Japan and throughout the West. However, from a broader perspective, this period of upheaval may also represent a strategic opportunity for other nations to strengthen their own industrial bases. Industries such as advanced semiconductors, automotive manufacturing, and shipbuilding could see a shift in the global competitive landscape as the technological gap widens. History has shown that periods of crisis often serve as turning points that dismantle the existing order and create space for new leaders to emerge. Beyond the weight of internal contradictions and the slow decline of a massive economic system, we must look for the opportunities that arise during such transitions. Understanding these risk factors is essential for anyone seeking to navigate the complexities of the modern global economy and protect their own financial future. Among the various challenges discussed today, which do you believe will have the most significant impact on your life or the global market in the coming years? We invite you to share your perspectives in the comments section, as your insights help provide a more comprehensive understanding of these global shifts. If you found this detailed analysis informative, please consider subscribing to the channel and providing your support through a positive rating and notification settings. Taking the time to stay informed about these structural changes is the first step in preparing for the economic landscape of the future.